The Federal Reserve took a significant step, announcing new framework to keep interest rates low and allowing inflation to temporarily exceed its 2% target. To break down what this means, we have Jordan Jackson with Asset Management's Global Market Insight Strategy team. Jordan, you're probably hearing from investors who are concerned about inflation. Why is inflation something we should pay attention to?
It's a great question. First, let me start by explaining what exactly inflation is. It's essentially the price on a basket of goods and services that you or I consume over a period of time. Now, if inflation is too high, it tends to limit our spending capacity in the economy. And so, for example, in an extreme hyperinflation type of environment, you can imagine a world where everyday consumers are racing to the grocery stores to buy items before the prices go up. On the other hand, if inflation is running too low, that's essentially associated with a weak economic environment reflective of low wages and really weak demand. So inflation is critically important, not just for policymakers, but for everyday consumers and Americans alike.
This global pandemic has required social distancing. States are still mandating some businesses to stay closed. How has this impacted inflation compared to previous recessions?
I think it's really important to assess these business closures and the impact that they've had on the broader labor market, and then tying that into how that has impacted inflation dynamics. So we know that typically recessions are associated with heavy amounts of unemployment. And that's been true this time around, unfortunately, as well. We've lost about 22 million jobs over the months of March and April here. We've since clawed some of those jobs back, but it's still a very challenging environment for many, many Americans. And typically associated with this wave of job losses is a loss of incomes. What's been offsetting those loss in incomes have been government stimulus by the way of one-time stimulus checks, as well as additional unemployment insurance benefits that have been added on top of normal state unemployment insurance. Now, if we did not have some of that government stimulus, it's likely that we would have been in a disinflationary type of environment for a longer period of time. We saw inflation peak in February of 2020. We saw those disinflationary pressures beginning to set in through much of March through April. We're now starting to see, as businesses open back up, as the economy gets back online, we're starting to see some of those inflationary pressures starting to come back.
So, what's the Federal Reserve's role in all of this, and what is the Fed attempting to do?
So I think the Fed's role is really twofold. The first is they've been trying to avoid sort of a financial market meltdown, similar to like we saw in the global financial crisis back in 2008, 2009. By doing this, what they've done is they've essentially restarted their asset purchase programs. And they've also established a host of credit facilities to ensure they are the lender of last resort throughout the economy. I think the second thing that the Fed is really trying to do is keep interest rates anchored at near zero in effort to try to encourage spending as the economy opens back up. One of the things that we've noticed that's been quite interesting is that super low interest rates have really helped the housing market. We've seen building permits come back, and we've seen, people stepping back into the housing market, buying new homes. And we've also seen that play out through car sales as well, recognizing that it's a bit cheaper to step in to buy a car today than it was before. Now, another element that the Fed has maybe further complicated things is they've taken an average inflation targeting approach to their policy framework. Now, what that means is that they'll allow inflation to run a bit hot or above that 2% level that they traditionally target to compensate for inflation that runs persistently low for a period of time. Taking all that away, I think the main thing that the Fed is trying to communicate to the markets is that they're willing to allow inflation to run a bit hot here for the foreseeable future.
And now that the economy is starting to reopen, what does that mean for us? Are there risks to higher inflation?
Yes, there are certainly risks. As the economy opens back up and more people become employed again and regain those wages, we're likely to see consumption trends begin to start to pick back up. I think what's been pretty interesting, we saw spending patterns drop the least and bounce back the quickest for low income earners. And I think that's a reflection of some of the government stimulus that we've seen come down over the past couple of months here. And I would also add from a business side of the equation, one of the things that many of us may have noticed in stepping back into our barbershops and hair salons that some of them may be charging a little bit more. They're just recognizing that after a few months of closures, that some of those businesses, as they start to open back up, may start to charge higher prices in order to compensate for that period without receiving any revenue.
So, what are ways investors can manage their portfolios during these times?
We think there are really three key ways that investors can manage this sort of inflation risk within their portfolios. We think the first is a greater degree of exposure to both domestic and international equities. We know that equities are the growers of the portfolio over the long run, and the return potential for equities far outpace that of the expected rate of inflation. I would say the second thing to sort of hedge against some of this inflation risks are assets like commodities. So assets like gold and silver. Again, those types of commodities are denominated in dollars, and so as inflation potentially moves higher, the value of the dollar falling, that provides a nice tailwind to some of these commodity assets that could be a nice hedge as well. And then lastly, I think just outright inflation hedge type of products, things like Treasury inflation protected securities or TIPS, and floating rate notes can potentially be another way that investors can hedge against this risk.
Well, thank you for joining us today, Jordan.
Thank you for having me, Christina.